In this video, you will learn the difference between long versus short positions in Forex trading. Gaining a grasp of the foundational concepts of going long or short in Forex is essential for novice traders. The decision to take a long or short position hinges on whether a trader anticipates a currency will appreciate or depreciate in comparison to another currency. To put it simply, if a trader expects a currency to appreciate, they will enter a long position on that currency. Conversely, if they foresee the currency depreciating, they will initiate a short position on the currency. Continue watching to delve into the intricacies of long and short positions in Forex trading and when to apply them. What defines a position in Forex trading? In Forex, a position refers to the amount of a currency held by an individual or entity, thereby exposing them to fluctuations in the currency's value against other currencies. This position can be either short or long. A Forex position entails three key elements: the currency pair being traded, the chosen direction, the position size. Traders have the option to take positions in various currency pairs. When they anticipate a currency's price will rise, they may opt for a long position. The size of the position they take will depend on their account's equity and the margin requirements. It is imperative for traders to use an appropriate level of leverage. What does it mean to have a long or short position in Forex? Grasping the concept of having a long or short position in Forex entails predicting whether a currency pair's value will rise or fall. Choosing to go long or short constitutes the foundational essence of participating in the financial markets. Opting for a long position signifies an optimistic outlook, with the trader anticipating an asset's value to increase. Conversely, adopting a short position indicates a pessimistic stance, with the trader expecting the asset's value to decrease, allowing them to repurchase it at a lower price in the future. What is a long position and when to trade it? A long position in trading signifies the execution of a trade where the trader anticipates an increase in the value of the underlying instrument. For instance, when a trader initiates a buy order, they assume a long position in the underlying instrument, such as US dollar to Japanese yen. This indicates their expectation for the US dollar's appreciation against the Japanese yen. For example, if a trader has bought 2 lots of US dollar to Japanese yen, they hold a long position of 2 lots in US dollar to Japanese yen. The underlying is the US dollar to Japanese yen, the size is 2 lots and the direction is long. Traders seek buy signals as a trigger to enter long positions. Indicators play a pivotal role in identifying buy and sell signals for market entry. A potential buy signal emerges when a currency reaches a support level. In the provided chart, US dollar to Japanese yen descends to 110.274, a point at which it finds consistent support. This 110.274 level becomes a support threshold, presenting traders with a buy signal whenever the price retraces to that level. One of the Forex market's advantages is its nearly continuous 24 hours, 5 days per week trading availability. Many traders opt to engage during major trading sessions like the New York, London, Sydney, and Tokyo sessions due to heightened liquidity during these periods. What is a short position and when to trade it? A short position operates as the antithesis of a long position in trading. When traders assume a short position, they anticipate a decline in the value of the underlying currency. Shorting a currency involves selling the underlying currency with the expectation that its price will diminish over time, enabling the trader to repurchase the same currency later at a reduced price. The difference between the initial higher selling price and the subsequent lower buying price constitutes the trader's profit. To illustrate, if a trader shorts US dollar to Japanese yen, they are essentially selling USD to acquire JPY. Traders seek sell signals as triggers for entering short positions. A prevalent sell signal emerges when the price of the underlying currency approaches a resistance level. A resistance level represents a price point that the underlying currency has struggled to surpass. In the depicted chart, US dollar to Japanese yen climbs to 114.486 and encounters difficulty progressing further. This threshold transforms into a resistance level, offering traders a sell signal as the price nears 114.486. While some traders prefer exclusively engaging during major trading sessions, opportunities can arise at virtually any point when the Forex market is open, allowing traders to execute their trades.